All right. Well,
Alrighty.
woohoo! Welcome back. Another action-packed day here for the 2021 Sofa Summit. What are we going to talk about today?
Well, yeah, guys, we are on day 4. Holy moly, we're super excited for today. So, first in our lineup is Greg Iverson. He is one of our preferred lenders that helps lend to all of our investors. If you're looking for a loan, you can get one for as little as 20% down to buy one of our properties
Yep.
and use that loan to your advantage and get a levered return on investment, then Greg is your man to hear about. I really like Greg. He has a lot of experience and owns lots of rentals himself, so he knows the business. He is here with you when things go wrong. He's experienced all that. He's right here on the
Yep.
ground with us and can really give you a lot of insight and consulting from there.
Definitely. Next up is taxes. One of the best parts of investing in real estate is you get tax benefits. And essentially, why we have Chris coming on is he's my personal accountant. And so I can definitely vouch for him. He does an amazing job. He's the owner of the company, and he focuses on investors in real estate, also in investors in Tennessee, because he's actually located in Tennessee as well. So you'll learn a lot about what tax write-offs you can actually use, because it differs depending on where you live, what your income is, what your employment status is. So you'll get a lot of the tax benefits, but the question is, can you use them? And that's what having a accountant and CPA is for, to let you know what you can use and how to optimize your taxes.
Great. Then next on the lineup, we'll be going into one of our properties again. We're taking to a new property on 317 Avery Jordan. It is in South Haven, Mississippi, an A-class,
Yep.
A-minus neighborhood. We'll be doing a deep dive of the reno, what it looked like before, during, and after, and a little bit of a drive through the neighborhood for you to kind of get a peek of what an A-minus class neighborhood feels like.
Yeah, we're excited to bring Mississippi to you guys as well. So sit back, relax, grab the notebook, and make sure you hit subscribe if you haven't done so already, and enjoy the day.
Thank you.
Hey, everybody, welcome to the next session for the 2021 SOFA Summit. I am thrilled to introduce our next speaker here, Greg Iverson with Delmar Mortgage. Greg, welcome. How you doing today?
Mark, thanks for having me. I am fabulous. Last time we did this, a little bit more casual. Now that we're back in the office, I dressed up for you today, man. So I'm not on my couch. I wish I was, but
Well, we're thrilled to have you back. It definitely means the world. So for all of you out there on your sofas watching right now, Greg is able to help real estate investors purchase more rental properties. Right. He is one of the top lenders that we've been working with personally for many, many years now. We've done hundreds of transactions together. And their team is just rock solid, seamless. They have an amazing, basically program and process that they can put you through. But what he's going to talk about today is some of the benefits of financing versus paying in cash. As some of you may know, if you finance and leverage these properties, well, your return on investment can increase just by the fact that you got the loan, right? Then you can also, he's going to talk about the ways that you can use cash and financing together to actually increase your likelihood or the chances of getting a property in this crazy real estate market. So, Greg, why don't you take it from there, share your screen, and rock and roll.
Mark, thank you. Yes, and real quick, thanks again for having me. We appreciate the partnership. I think it's a two-way street. So hopefully we add a lot of value to you, as I know you certainly have for us. So let me jump in here. I'll kind of introduce myself, who I am, what I'm doing. This has been a very interesting market, as I think Well, interesting is one word. There are many words to use to describe the last year and a half or so now. It's having gone through 2008 timeframe. I thought that was the wildest thing we'd ever seen. I have to be perfectly honest. This is even more exciting to me. I don't necessarily see all these foreclosure opportunities that I did in '08, maybe, but still tons of opportunity out there, and watching the appreciation, everything else. Low interest rate environment. It's just been a great time for real estate in general. So the one I titled today, Winning in Today's Market, a lot of the feedback we get from our clients is things are a lot different now, and how can we position ourselves, or what opportunities are available in this market versus markets of years past. So I wanted to talk first for anybody that's seen one of my talks or classes or anything like that. I always like to start a little bit with why are we doing this? Who am I? And then ending with some resources, which are typically books, things that keep me motivated to, ride the ups and downs of real estate. So why invest? In the beginning, I started doing it back in '06. It was quite honestly just to get rich. That was my only game plan, which was not a game plan at all. As time has gone on, I see the opportunity for freedom, specifically as it relates to spending more and more time with family. So these are my 3 kids. This is what my wife and
Greg,
I.
before you go too far, you want to share your screen? We're just looking at your beautiful face.
Yeah, that may help.
Yeah.
I didn't say I was tech savvy.
That's what I'm here for. I got you.
Let me. I'm a lot better at real estate and lending than technology. All right, here we go.
Share screen. There we go.
How's this?
That's beautiful.
All right, here we go. So
there we go.
Let me back up real quick. So winning in today's market, retire with rental real estate. The way I position this talk today is more what opportunities are available right now. First off, we'll talk about, but then paying cash versus financing. We get the question all the time. I've asked myself the same question for years, many times over. Admittedly, sometimes the answer has probably been a little bit different for me. So there's certainly not a one size fits all approach, but I do want to open your eyes to the pros and cons of doing each and how to evaluate that, and see what works for you. So back to my why doing this. So why invest? In the beginning, like I said, it was just basically to get rich. That was my only plan. Then financial freedom, children, family, that started taking over in my life. And I now, having invested in real estate for 15 years or so, I can look back and see some of the freedom that's created to be able to spend time with family and, travel and all that sort of thing. So 15 years in the business, both the lending and rental business now. '06 was when I began. I'm proud to be celebrating my 8th wedding anniversary this fall, and I've got 3 wonderful children, Blakely, William, and Maudie, 6, 4, and 2. Like everybody else, we're working to manage the chaos in this COVID world. So today's agenda, I want to talk a little bit about offense versus defense as it relates to buying rental property and investing in general. I do want to talk about cash versus financing, the rates of return and some of that sort of thing. I do encourage you to ask questions in the chat bar. I'm here to, interact with you. And if there are questions, please put in the chat bar. Happy to run through those to the best of my ability. So again, who am I? I have this conversation, I feel like multiple times per week when someone calls our office to talk about lending and that sort of thing. I always tell people, I look at myself first as an investor, as a lender second. Now, lending happens to be my full-time job, but I look at it from the lens of the investor first. Having been an investor myself for a while now, I'm able to look at it from your standpoint, from the buyer standpoint. And I think that helps, to evaluate the overall strategy, having, done it before and seen some different markets and that sort of thing, different climates. I did begin investing in '06, like I said, with a line of credit on my parents' home. We've done single family homes, multifamily, farmland, vacation rentals, rehabs, some retail commercial space, as well as office space, up to about 75 units, down probably a little bit now after having sold a few last year, but still actively looking to acquire and grow the portfolio. On the lending side, we've been lucky that we have been ranked as the top lender in Missouri, as well as one of the top lenders in the country. So it's been a good partnership with MIP and many others. Many investors out there have helped us grow quite a bit over the years. So should we buy in this market? This is the question I get 5 times a day or so, I would estimate. Offense versus defense is the way that I look at it. And my answer always to people is, are there, foreclosures flooding the streets, properties? Is it a buyer's market? I wouldn't say that, but I do feel like in every market there is opportunity. I'm actively buying in this market because of how low interest rates are. The Fannie Freddie options right now are the ones that you can lock up and set up for, 15, 20, 30 years. So, are prices up a little bit? Sure, appreciation has set in over the last few years, but to offset that, rental rates are up, interest rates are low, still creating great opportunities. So I always encourage people, look at each market as an opportunity, and not necessarily that, there's so much competition out there, there's no way I can fit in. Do you have to be a little more selective? Absolutely. Do you have to find the top-notch turnkey company like MIP? I believe so, yes, because I think now more than ever you need, trusted confidants. You need advice from property managers, from turnkey companies that have been through markets like this, that are in it for the long haul with you, and I think that's huge. I think going it alone, what I did back in 2008 of rehabbing homes, basically just gunslinging by myself, I don't know that this is the market for that personally. I would be plugging into knowledge right now, building the foundation. If we do see a housing collapse, then you have a foundation built. You've learned some things, you know what you're doing, and then maybe capitalize on that. I personally don't feel like this is the market for that. I think this is the market for the pros to do it, such as, Mark and your team, obviously. So be selective and seek guidance. That could be from Mark and team, from the Reedies. It could be from your accountant, others, your lender, like myself. Really plug in and listen to others that have been through this before, and some for many, many years, and seen some up and down markets overall. So cash versus financing. So really the meat and potatoes of what I wanted to talk about today. And let me preface this, of course, by saying I am a lender. So I do believe in the beauty of leverage, as I think many others in real estate outside of being a lender would agree. But I also grew my own portfolio with leverage. I still today, seek leverage, especially where, interest rates allows me to scale and grow bigger, faster. So things to think about on the cash side, cash flow. Is it greater with paying in all cash, dollar for dollar per month? Sure, it is. Scale. Are you able to grow quite as quickly? What are the cash on cash rates of return? And then sleep. I always mention this, the sleep factor. At the end of the day, if you feel better knowing that properties are paid off, that your real estate is free and clear, I think there's a lot to be said for that. It's the same conversation of a 30-year versus a 15-year fixed rate. I could show you the math all day long that a 30-year you're better off doing, and I personally do believe that. However, if a 15-year you realize you'll be paid off at a certain age and that makes you feel better and sleep better at night, I'm not about to argue that. So something to always think about. Financing on the other side, other people's money, the ability to use leverage through banks, other lenders out there. Interest rates and loan terms, are they good? Is it a good time to borrow? I happen to believe right now is. And then cash flow. Are you taking on too much leverage? Does it hinder your cash flow to where or is your portfolio leverage too much that if you do have one little hiccup, are you sweating it big time? Are you, again, not sleeping up all night thinking about it? So definitely something to consider. And then scale. The ability to finance and use leverage helps real estate investors, small and large, to scale and buy faster. Again, like I mentioned, if I had done cash from the beginning and needed to save up all the cash, would have taken me who knows how long. I certainly wouldn't have the number of properties, but I don't know that I, ever would, or it would take quite a while anyway. So, and same goes for many other investors as well. Cash on cash rate of return. So this is really what it comes down to. And it's basically your cash flow divided by your initial equity. Initial equity in a cash purchase would be the purchase price, essentially, plus any fees you would pay. That gives you your cash on cash. The initial equity in a finance transaction would essentially be your down payment and any costs and fees that you pay as a part of the closing. Calculates the cash income earned on the cash invested in a property. So it's basically a way to determine how hard your dollar is working and to quantify that in a rate of return of some kind. So this, in my opinion, is the best one to calculate financing versus cash. Mark, as you know, there's many different, a lot of different formulas we can use. We can use cap rates. We can use all these different analysis tools. In my opinion, well, in general, I think you need to know which tool applies to what answer you're actually after. In this case, I believe this is probably the best to calculate just to get an actual return percentage. So let's run through and do a little bit of math. I don't want to bore everybody with the details, but let's suppose you have $100,000 to spend. You've chosen real estate as your path. That's how you want to reach financial freedom. Biggest question now, do you go out and buy one home for $100,000 or do you buy 5 homes? And using leverage, putting 20% down, $20,000 per property, you use that same $100,000. In that case, you take on 80% loans, so $400,000 in debt, but you control $500,000 in real estate versus $100,000. Each home rents for $1,150 per month. So these will stay the same regardless. Each home rents for $1,150 per month, carries a tax and insurance payment of $175, and expenses, including management, maintenance, reserves, et cetera, are $350 per month. So total monthly expenses then are $525. So now let's look at cash versus financing. So your cash then in the first example here, with monthly rental income of $1,150, total operating expenses are $525. You have no debt, so you don't have to worry about any mortgage payments. You've got $625 in cash flow per month. So annually, $7,500, pretty good. Cash on cash rate of return then, just basically 7,500 divided by 100,000, your initial investment, 7.5%. Not too bad. A lot would look for a good stable return like that. I would still believe that that's probably a better investment than some other things you could be doing, maybe crypto being one of them, maybe not. Financing ROI, however, when you look at this is where it gets really exciting for me. So using a 20% down payment, investor decided instead to buy those 5 homes at $100,000 a piece. So controlling effectively $500,000 in real estate, borrowing 80% on each property, doing a 30-year fixed rate in today's market at 4.5%. Monthly mortgage payment comes out to $405. So what you want to do then is you add your $405 to your $525, which are your other expenses to operate the property, gives you $930. So those are that's your total cash outlay per month. Resulting cash flow then is $220, not nearly as attractive as the $625 that we came up with in the cash example. However, so it gives you $2640 annually. However, if you look at the actual return on it, 2 ways to look at it. One would be you take that $2640, divide that by your $20,000. All of a sudden, your cash on cash in this case then is 13.2%. Not quite double, but significantly more than the 7.5. Pretty staggering number, if you ask me. Another piece that's quite interesting, if you just look at dollars and not even the returns, those 5 properties then times 2640 gives you 13.2. So 13,200 in total cash flow versus 7,500. So as you can start to see, Mark, and especially as you do more and more of these, the numbers start to pull away from each other pretty drastically. Again, it's not for everybody, but looking from a pure standpoint, which is the way I personally look at it in making my decision, looking at what that dollar that I'm putting in is actually earning. For me, it's a pretty simple decision.
Definitely. And a lot of people say, like, how is that even possible? How does that math make sense? And the key factor is the interest rate, which is at 4.5%, which is a historical low over the previous multiple decades. Now, if that interest rate was 10%, this math, it wouldn't be more attractive to go financing. It would be more attractive to pay in cash. So that's one of the main reasons why it is such a great time to buy now in this environment, is because we still have historically extremely low interest rates. I mean, below a 5%, that is just absolutely wild. I mean,
it's crazy.
Jim Reedy, my partner, they threw a party when they had 12% interest rate. 12%, they threw a party.
They've got a lot more experience than I do, but even when I started, the first one I did was 7.25, you know, and the math made sense.
Yep.
But it makes even more sense today with this, you know. So yeah, and the other thing we're not factoring in also is, if you control 500,000 in real estate and you get 3% appreciation, dollar for dollar, again, that's a lot more appreciation than that $100,000 home.
Oh yeah. Oh yeah. That's probably one of my favorite parts about it, is because now your appreciation is leveraged, because you're only putting 20% down, but you get to keep all of the appreciation on the entire portfolio. So in, this instance, essentially, if you paid in cash and the property appreciated, let's just say 3% to be conservative, that's a 3% annual ROI, assuming you paid in cash. But if you finance and put 20% down, technically 1/5 of the property, you now have to multiply that appreciation rate by 5, and that will be your annualized ROI. So 3% ROI is a 15% 3% appreciation using financing is a 15% ROI. And what's wild is we just saw the numbers here for Memphis, Tennessee, and we appreciated 14% last year. So just do the math there, multiply that by 5, and hey, that's enough for me.
It's crazy, man. Yeah, absolutely. And these are real numbers in today's environment. These are not like pie in the sky type math, which is the cool thing. And yeah, it just, to your point, Mark, it from there, it just starts to snowball, and over 10 properties, 15 properties, so on and so forth. So, anyway, cash options. So here's another piece, and something I do want to talk about real quick. In this market, we're getting more and more questions. What if I pay cash? That will put me at the top of the list to be able to acquire more properties and that sort of thing. And so I think it does take a little more strategy. In that case, yes, you can pay cash. You still reserve the right to take out a loan after the fact. You can, and like we were talking about right before we jumped on the call, I think a lot also have this misunderstanding, and it's probably our fault for not communicating it better, that there are sorry, I just lost my my train of thought there.
You can refinance quicker.
Yeah, I'm sorry. So you don't need to wait a year. You don't need to wait 6 months even. You can refinance pretty much right away, and that's another piece that, again, being able to get your cash back out and move on to the next property, that timing is just crucial. So there's not.
What do you call that? What do you call that strategy?
A lot of different probably names for it. We call it delayed financing, but there are a lot of terms. It's at the end of the day, the overall goal is to get your cash back out, move on to the next thing. But also, if you're in a competitive situation and a seller is looking at multiple offers, that cash offer, as I'm sure you could testify to, Mark, goes to the top of the pile. And so that, even though you take out a loan in the future, so end result is the same thing, you're able to actually buy that property as opposed to missing out, quite a bit trying to get one. So I want to talk. So, obviously everybody does not have 100,000 in cash laying around. There are ways to get creative that technically it's still a cash transaction. There are private lenders out there that lend on hard money basis. Securities margin line of credit, that's one of my favorites. If you have an account at an E-Trade or Wells Fargo or something like that, outside of retirement, you can actually take a line of credit on those assets, and it functions just as cash. I've done it personally where I've used that to buy a foreclosure or something that didn't qualify for financing. It still makes you look like a cash buyer. To the seller, it still is cash, but you're not needing to save up that 100,000 in your savings account, over time. HELOCs, second mortgages, I would say those are the most popular. That and whole life insurance, those are probably the most popular that we see. And then, of course, just straight up cash. Positive, negative, and neutral leverage is something we get into at that point, which is kind of the whole topic here. Are you better off leveraging or not? Rich uncle, I like the rich uncle program. A lot of us don't have that, but if you do have a family member or someone that that can provide that money to you, a lot of times we'll see it set up, and I don't want to go all the way down the rabbit hole of underwriting guidelines, but a lot of times we'll see it set up as an actual mortgage. So back to the top here of private lenders, that rich uncle actually puts a deed of trust on the property, so it's not treated as a gift or anything like that, and then you refinance that way down the road. So those are ways to get to cash. Pros and cons. So financing pros, again, the ability to scale. You can go a lot faster. You buy 5 properties opposed to 1, like we just talked about. Attractive terms, the way they are today, I think they're as good as they've ever been. And what I mean by that, long-term fixed rates, you're allowed to do 10 properties. It wasn't so long ago where we were limited to 4 properties with Fannie Mae and Freddie Mac. So 10 properties. 10 per spouse. So theoretically you could do, up to 20, for a married couple or a partnership. So that I think is phenomenal. 30-year fixed rates. So you lock that in. That's, as you saw in that previous example, that's a higher expense than operating the property in general a lot of times. And so, or very, very close. So if you're able to set that number, what it is, you don't have to worry about fluctuation, and it really helps to make a better investment. Greater cash flow. So this is the one that's debatable. Dollar for dollar, it's not on that one property. On the 5 properties, it was obviously, but the actual on a percentage basis, it is. And of course, higher cash on cash returns. The cons, reduced cash flow. So again, the exact opposite of what I just said. Reduced cash flow being that in that one property example, on a monthly basis, you're actually walking away with less cash because you have to pay that mortgage note. 2008, for anybody that went through that, we saw many properties, many mortgages underwater. So that's always a risk. If you're in for the long haul, that's not something that concerns me, quite honestly. But if it is somebody that's looking to buy and sell in a few years, that's definitely worth considering if we do head into some sort of recession. Sleepless nights, so if you watch property that would start to depreciate or lose value, I guess we should say, are you getting to that point where you don't have a lot of equity and could potentially end up underwater? Could definitely lead to sleepless nights, if you ask me. And then access to capital, not all the time financing capital is available out there through banks and mortgage companies. It does right now happens to be a great time, but there are times where lenders are not real excited about investment property. Again, with the perception that we would head into a recession, that's one thing that can make banks and lenders skittish. So cash pros, quick closings, like we talked about, maybe puts you to the top of the list. No contingencies, so the seller views that as a better offer a lot of times. Simpler, cleaner, quicker closing. You don't have interest expense, so again, on a dollar basis on that one property, like we talked about, you're walking away with more money each month, more dollars. Better sleep, potentially, and you can finance later. That to me is probably the biggest pro. If you either A, go in with that intention, or we've had plenty that paid cash for some properties and then thought on it or ran the math like we're doing here right now, only to call us and say, let's go ahead and do financing on all these. It would allow me to, actually, we're looking at somebody's portfolio right now. There's 12 to 15 of them that significant equity and some are paid off. And, he's analyzed and said, I can really scale this thing now if I pull some of that equity back out. So you can do it.
That's a big one. That's a big one right there, is that you can buy a property, you can use financing, day one, and then hold on to the property for a couple of years and let the tenant pay down your mortgage, let the property appreciate. And then you can call Greg and say, hey, should I do a cash out refinance? And he'll run the math and he'll let you know how much cash he could give you, essentially tax-free, that you can then go use that as down payment money to go buy another property. And that's really how you scale if you're trying to build a portfolio, for the future. And if you're really planning for 5, 10 plus years down the road.
100%, Mark. And I would say in the last year and a half, with where, appreciation is on the rise, so equity is higher than it's been in a long time. And with where rates are, we've seen more doing just what you said than I've ever seen, so.
Definitely. Yeah. The
Great
clients
time.
that we help buy properties when I started here 4 years ago are all able to do a cash out refinance, which is amazing. That means they can double their portfolio in 4 years, which is wild.
And use that for a syndication or for other rental homes, all sorts
Whatever
of
they want. Yep.
what we've seen. Yeah, absolutely. And then of course, we've got to talk about the cons. So slower growth, takes longer to save that money. Rather than buy 5 properties, you buy 1, like we saw in that example. Lower cash on cash rates of return, like you saw, 7.5% versus 13.2%. Big difference there, huge difference. Delay property acquisition, so taking time to save up. It may take several years to save that 100,000, or many years to save that 100,000 versus 20,000 is a little bit easier to scrape together. One thing I will say, and I always caution people that I've been guilty of this myself in a cash transaction, there are certain things that the lender requires in the form of due diligence, making sure it's not in a floodplain, value, inspections, appraisals, any of that kind of thing that is required in financing. I would suggest at least considering it, but probably doing the exact same thing even if there's not a lender requiring it, so not getting sloppy just because you're paying in cash and not really still doing your due diligence, which again, in the turnkey model, specifically with your crew, those types of things are handled and guidance is provided. But in general, just things you still want to think about whether you're financing it or paying in cash.
Definitely. Like one example is a termite inspection. You are required to get a termite inspection when you finance, but if you pay cash, you are not. But we still have every single one of our clients get a termite inspection because it's $75 and it's just the smart thing to do. Right. So that's just one example to where you also think of the benefits of financing is you're putting 20% down, but Greg and the bank, they're putting 80% of their cash in.
Yeah.
Right. So they care more about how this property is going to perform and make sure it's in good condition and make sure it's a good value, than you do, because they have more capital at risk, which I think is an interesting way to look at it.
Exactly. It's a partnership with the lender. However, the lender does not get to reap some of the benefits of appreciation and other things that you would in a normal partnership. So
it's a great deal. That's for sure.
It's a great deal. It's a great partnership for sure. So let me wrap up and then we can run through any other little pieces. But I'm a big reader, and especially as it pertains to real estate investment and things, I'm always looking for different ideas or just motivation, that sort of thing. So I want to just share a few that I happen to really, really enjoy. Millionaire Next Door is a great book. I try to read it every year. Richest Man in Babylon, Rich Dad, Poor Dad. Mark, I know we've talked about this. That's what got my mind going right after college and got me thinking about this path. As many others I've talked to in this space, that's what got them turned on to this.
You got it. Yeah, that was the same book that I read as well that changed my entire paradigm, essentially. It just made me look at the world differently. And it took going through undergraduate school to finally get access to the book that changed my views on business and the future, so that's where you should start right there. If you haven't read it yet,
cheapest education out there. You're exactly right. It's if nothing else on this list, that book will change your life. No question about it. There's the principles in that book. I read it for the first time right after college, are still the ones that I employ day to day. Sometimes with not even thinking about it. It's almost just ingrained in me now. Creating Wealth is a good one. Think and Grow Rich. E-Myth Real Estate Investor. That's a really good one. Millionaire Real Estate Investor, and then The Challenge. So just a few to maybe check out. But again, Mark, if you're going to start somewhere, Rich Dad, Poor Dad would definitely be mine. Millionaire Next Door will give you ideas on saving and living a little bit more frugally so that you can ultimately invest in more real estate. So
millionaires don't become millionaires driving Bentleys. That's for sure.
No, sir. Nope. It's as a lender, it's shocking.
Right. You see all the debt to income ratios of everyone. Yep.
We do. And Mark, I and I'll stop the screen share here in just a second, but We do. And I always tell people and the reason I'm sold on real estate, which I was before I really started lending, quite honestly, but those that own real estate, whether it's on a passive basis or in full-time real estate investment, we see their financials, they stack up as good or better than anything we've ever seen, and that can be a highly educated professional, so on and so forth. Those that own real estate, by and large, get to that freedom, get to that wealth standpoint, so much faster, or just get there, period, from our experience. It's phenomenal. It's cool to watch.
Definitely. And that's the thing. That's the building block, right? Is you need to read The Millionaire Next Door. Fantastic book. Read it multiple times. You need to have a budget. You need to work on your credit score. All things that we can, we have partners that we can refer you to that's what they focus on, right? Is helping you get from, negative net worth or all the way up to ability to take financing and ability to scale. Definitely.
Yep. Absolutely. So that's what I've got for today, Mark. If you have any questions, obviously I can talk about this stuff, all day long. I guess let me kind of wrap up the cash versus financing standpoint. There's not a one size fits all approach for anyone. I am a lender, so I happen to love the idea of leverage. I'm also an investor, and in that side of it, I love the idea of leverage. And so, that happens to be my own personal opinion. There is no one size fits all, but I would certainly, for those even that are a little skittish, maybe a little bit concerned about taking on debt, to look at it more as a tool. This is not a credit card that you're maxing out to go to Vegas. This is a long-term asset, ideally an appreciating asset over time, and the ability to use other people's money, the bank's money, however you want to call that, allows you to scale and get to that goal, within a lifetime, or within sometimes just several years.
Definitely. I like what you said, using financing as a tool. It doesn't always necessarily have to be the end game, the end result. What a lot of our biggest clients are doing is they're using financing to scale, as in to acquire 10 properties or 20 properties with their spouse. And then the goal is to use the debt snowball effect with Dave Ramsey and pay off the cheapest mortgage with all the cash flow of the entire portfolio as quickly as possible until that mortgage gets paid off. And when the mortgage gets paid off, like Greg said, the mortgage is normally the highest expense you have. So now your cash flow on that one individual house almost triples, essentially.
Exactly.
And then it snowballs from there to where, imagine having 10 or 20 fully paid off income producing properties into retirement. That's really all you need for most people. It's powerful. And then you can sleep well at night. So there's a lot of different strategies that you can deploy, and use financing as a tool. And that's exactly why you just need to have a one-on-one consultation, with Greg to figure out what's the best fit for you, because everyone's situation is different. Everyone's goals are going to be different. But at the end of the day, Greg's the man. So how do they get in contact with you?
Got that right, buddy. Yes. So my contact info. So our phone number here, 636-751-1068. And then my email address here. So giverson@delmarmortgage.com, which we can drop into the chat as well. But reach out to us anytime. I always tell people, whether we do a loan together or not, obviously we'd love to earn that trust and your business, but I love to talk about this stuff. So if you just want to, talk about strategy, talk about your game plan, I'm all for that too. So reach out to us anytime.
Awesome. Well, we appreciate you, Greg. Thank you so much. And everyone, on to the next session. Thank you, guys.
Of course, Mark. Thank you.
Well, guys, you might be seeing this Yeti hanging out right here. And so what we're doing is we're going to give away a few Yetis to some lucky individuals.
3 lucky individuals. And there's 3 different ways to win the Yeti. The first one is, you've already done it, is just register and attend the actual event. then the second way to win the Yeti is to subscribe to our YouTube channel. And the third way to win a Yeti is to be interactive and have the best comment in the little chat bar.
Yep, so be commenting. Let us know your thoughts, comment, or question. We will consider on helping you win that Yeti. So thank you so much, guys, and we appreciate you being here.
Welcome, everybody, to our next session for the 2021 SOFA Summit. I am fired up to introduce my personal CPA and the next speaker here, Chris Picciurro with Integrated Financial Group. Chris, welcome. How are you today?
Oh, thank you so much. It's an honor to be here, and I always love these events, and I always tell you how much I wish I was at the International Barbecue Competition, but having virtual events is very effective, and I don't take any of these opportunities for granted. So I love working with you, and I'm happy to provide information at any time.
Yeah, we really appreciate it. So what we're about to talk about now is taxes, right? And one of the big benefits of owning real estate is that you can get certain tax write-offs or certain tax benefits, but it's confusing, right? The IRS tax code affects everyone differently based off of where you live, how much income you make, what you qualify for. Are you a full-time real estate professional? Is this a passive investment? It gets pretty wild, right? And that's why it's recommended, if you've got a rental property, I recommend to have a CPA like Chris, to where you can send him all the documentation needed, and he'll let you know how to maximize those tax write-offs to get the most value and ultimately to pay the least amount of taxes at the end of the year, right? Because that's the goal. So I'm going to pass it off. Yeah, so I'm going to pass it off now here to Chris and let you share your screen and take it away.
All right, well, again, thank you so much. I want to say our goal as a firm is always to legally and ethically reduce the taxes you pay in your lifetime. And that is our calling card. That's our goal. Let me make this a little bigger here. And like you mentioned, Mark, every situation is unique. Everyone's risk tolerance is unique. Everyone's fact pattern is unique. But what I can say is that we spend about 90% of our time, about 90% of our clients are real estate investors. And I agree with you. Once you start investing in real estate property, make sure you find a CPA firm that is a partner or an enrolled agent. They are going to be one of your business partners. So that's very important to understand, or they're going to be on your board of directors rather. Mm-hmm. And that's very important to understand. So I know we're putting together about a 6-hour set of courses on tax planning, building blocks, and how it applies to real estate investors. But I want to keep this as 30,000 foot view as possible. So to just hopefully that by watching this, and if you are watching this, I really appreciate your time. Time is our most valuable resource. So having some of that's important. But if we could just jog a few things and you can take one solid or maybe two solid things away from this, then I feel like it was a success. So I'm going to start because you said the tax law is vast. And even within the tax law, there are different nuances in every industry. So to kind of, if we think about, we know about, regardless of your background and your beliefs, so we know about the 10 Commandments, and the 10 Commandments really set out how, you should behave if that's what you believe in. So the point is, I don't want to get in a different subject matter here, but the point is I thought, okay, let me think about my 3 laws of tax strategy and planning. Okay. Because the way we look at tax returns in our firm and the way I view it, and I think your accountant should view it, is that tax returns should be a verb, not a noun. So think about that. They're a living, breathing the tax return process is an active process. And Mark, I know we talk all throughout the year because that is so important. Okay, because if a tax return is something you do at the end of the year, then you're not going to get the best result that you can. So I'm just setting that up as a preface. So when I talk about my 3 laws of tax strategy and planning, one is, unfortunately or fortunately, the government is your business partner. They're an involuntary business partner. Okay, so that's kind of the bad news. But if you've ever had a business partner or a marriage, you could have a very good partnership, and the government can be a very inexpensive business partner. Here's the good news. You have the opportunity as an individual to pick your board of directors. So that means the people you're working with. If it's the Memphis investment team, that's going to be your source of gaining assets and gaining income. It's going to be, you're going to seek legal counsel elsewhere. You're going to seek CPA advice, financial advising, but you get to build that board of directors. You also get to write your own operating agreement. What that means is you get to structure things the way that works effectively for you, legally and ethically, reducing the taxes you pay in your lifetime. And that's a very powerful thing that you have. So think about blackjack. You know, you get dealt a certain amount of cards, but at least you're not the dealer. The dealer always has to hit on a certain card. You at least get to play your cards. And you know, we think about over the last year and a half, 2 years now, pretty much year and a half with PPP loans coming out, the economic injury disaster loan grants. In those cases, the government was a good business partner for you because you received tax-free money, right? That's not bad. But if you didn't have your taxes prepared, or you didn't have someone to bounce things off of to be able to submit the required documents to get those type of incentives, you lost out. So that's law number 1. Law number 2, your taxes based on your facts. I can fix a lot of stuff for 2021 here. There's not that much stuff I could fix for 2020. There are some, and I would say there are some tax strategies that you can use after the end of the year, but only about a third of the strategies that we regularly use can be utilized after December 31st. All right. If you don't like your tax return, then change your facts, change your situation. Think about that. So the third one, and the one that I'm really want to focus on with our real estate investor friends, is you're understanding the difference between cash flow and tax flow. So cash flow is pretty easy to understand. Tax flow is difficult to understand. So that's where how we do business is we try to have people understand tax flow, and understanding whenever you engage in a transaction, there's a tax ramification and there's a cash ramification, and they are completely separate. Sometimes they could be correlated. Sometimes they're completely uncorrelated. So those are kind of the 3 main laws of tax strategy. But I'm not sure if you have any questions or want me to keep rolling.
Yeah, definitely keep on rolling. And anyone that's
Okay.
actually on here watching, please ask as many questions as you have.
Yes.
We'll be sure to have Chris in the chat answering those questions live.
And what I'm going to do is I'm going to apply these laws to our discussion points. So let me show this. I wanted to come up with 5 main discussion points to talk about today. And again, yes, please fire away your questions. I will say we will get to all the questions, even if it's after the event. I know that you're getting a lot of information during the summit, and I'm going to give you several ways to get in contact with us. So I really want to be a resource. So let's talk about things. All right. Main thing, I know, obviously, I'm based in the Nashville area. I have real estate investments, and I will say only one of my investment properties are in the state of Tennessee. All the other ones are out of state. So that's important to understand the tax implications of investing across state lines. Very fortunate that in the state of Tennessee, we have no state income tax. So that there's a big benefit there. Now, I would say to you, typically with real estate investments, it's rare, and when we're going to talk about some of these items come in the other discussion points, but it's rare that you're going to have any type of major tax to pay on rental property if you make sure your fact pattern is to your benefit. But let's talk about a situation for someone that is in a tax state investing in a non-tax state. So I don't I know you live around Nashville, right? Have you seen any Californians move here in the last few years?
Just one or two, just one.
Right, exactly. So,
yeah. Right.
So we know that people from the coast and in those high value markets find investing here in Tennessee or like in Memphis and in around Memphis and in other markets that you can actually try to find a good return on your investment. As far as we all know, about getting close to the 1% rule and et cetera. But what happens if you're a California resident and you buy a property in Mississippi? Okay, so obviously Mississippi borders Memphis, a lot of great properties there. So in California, you're going to be taxed on your total income. Okay, but in Mississippi, in that fact pattern, you're going to file a non-resident income tax return. And the only thing you're going to report to Mississippi is that rental income and the rental deductions. That's it. If for some reason you owed tax in Mississippi, which at this point is about a 2% chance based on our client base that is invested there, because the rental properties, again, even though we're going to get to number 3, tax flow versus cash flow, but from a tax standpoint, it's very rare that you're going to have a tax due on net rental income. But let's say you did, you would actually get a credit in California for that I almost said Memphis, but for that Mississippi tax paid. So understand that you're not, just because you live in one state and you invest in another state, you're not double taxed. So that's a very important thing to consider. Now, if you're a Californian and you invest in the state of Tennessee, let's say your property is either in Memphis proper or outside of the city limits, we have no state income tax here. We do have a franchise and excise tax. We could talk about that in a little bit, but then you don't even file a tax return here in Tennessee. We don't have an income tax, and there's nothing to do. You would just put that rental property on your California return, and most likely you're not going to have any net rental income to pay tax on. Again, you're going to have cash flow, but net taxable income is different than cash flow. And that's why real estate's so great. But so that is a big factor when you're investing across state lines. Now, if you sell the property, depending on what state you're in, there might be tax withholding if you're a non-resident of that state. So in every state is different and each threshold is different. Now, we do have some advanced strategies to potentially defer the tax on it, such as 1031 exchange. I don't want to go spoiler alert on some of these advanced tax strategies, but we're going to talk about those. But there could be tax withholding. Just because there's tax withholding at closing, Georgia is one of a rather aggressive state that we have a lot of clients that invest in. If you sell a property, typically the title agency or the law firm closing on that property is going to withhold non-resident tax. Then you will just file a tax return. A lot of times you get a lot of that money back, or at least get a credit in your home state for that. So that's the tax implications of investing across state lines. I would be remiss to mention one more thing. We're not a law firm, so I'm not giving legal advice. It's just something to consider if you're creating entities, in investing in multiple states with those entities. Definitely talk to your attorneys, because there are some, a lot of times real estate investors want to have those entities in certain states. I'm not advocating for Delaware, Wyoming, or Nevada, but they're the ones we see all the time. I'll just go off the top of my head. And the reason that is typically because that the investor wants jurisdiction in those states. But again, I also see that a lot of investors, what I call over entity, they build a big F-250 and put a 4-cylinder engine in there. Yeah, so you don't want to do that either. So yeah, that's really the big thing on tax implications of investing across state lines. There are also things to consider as far as potentially local tax. If you have some municipalities will have a sales tax. If you have, now typically that's typically a situation when you have short-term rentals. If you have long-term tenants, that's usually you don't have to worry about that. So real estate taxes are going to be local. You just pay them, just pay them like your own real estate taxes. So, and those are all deductible. Now, I want to talk about how turnkey investments are taxed, because this is really hits on the understanding tax flow versus cash flow. So I know last summit I came up with all these different projections and case studies, but what I want you to understand is this. I thought, you know what, let me just keep this as simple as possible. I'm going to go back to number one, right? The government is your business partner. And what does that mean? It means that the government wants you to behave in a certain way and will reward you the way the tax laws are written to engage in certain activities. You will also be unrewarded. I don't even know if that's a word, but unrewarded or discouraged from other activities. Let me explain that. A W-2 in person. So someone that gets a W-2, you can put some of your income away to pre-tax 401k plan, health insurance premiums, what we call cafeteria style plan, a daycare. But for the most part, you are taxed on your gross income as a W-2 person, and you get no deduction for any of your employee business expenses. There are some rare exceptions. So before someone blows up the chat here, there's always exceptions to the rule, but there are some rare exceptions where you would, if you're in the military or what have you, but in general, you get taxed on your gross income, okay? When you're a business owner or real estate investor, you get taxed on your net income, not your cash flow, net income, which for the most part is going to be very small. So comes down to the question, how are turnkey rentals taxed? You're taxed on your net income, not your net cash flow. And you're taxed, you take your rental income on the top, and you get to take all your deductions that relate to that rental income. Anything ordinary and necessary in your trade or business. So that's going to be mortgage interest, any type of association fee, property taxes, property management fee. I think I mentioned mortgage interest, repairs, maintenance, and anything related to that property. Okay. On top of that, you get to deduct the acquisition costs of that property. So for easy math, all right, and you get to deduct that, I'm sorry, let me back up. You get to deduct that acquisition cost over a 27.5-year period. So I'm going to pull a calculator here on my other monitor and bring it over. So what does that mean? Let's say you buy a property for $130,000, okay? And let's assume, we're assuming you're not buying it in a self-directed IRA, by the way. That's another presentation. But you buy the property for $130,000. The rule of thumb in general is 20% of that property is considered land, 80% building. That's just a general rule. We'd have to examine the property tax records to determine that. But I'm going, okay, so $26,000 of the property is land, which tells me $104,000 of that property is building. Ooh. I think I knew how to do a calculator. I've been a CPA for 20 years here and I can't run this calculator. So every year for this property, we take the 104,000 divided by 27.5 years straight line depreciation. You're getting approximately a $3,800 tax deduction every year, even so, without having to pay $3,800. Okay, so that's That's that difference between cash flow and tax flow. I want to point another thing out for you. This depreciation deduction, let's bring it back over, has nothing to do with if you paid cash for the property or you have a mortgage. Cash flow versus tax flow, okay? It's irrelevant when it comes to that calculation. So in general, let me just play, Mark, we're just gonna freestyle it here. Let's say we have $3,800 worth of depreciation. Let's say you buy a property and your gross rent's $1,100 a month, okay? And let's say your costs are $700 a month, all right? Net cash flow is $4,000 a year or $400 a month. Times that by 12, your net cash flow in $4,800, right? Pretty darn good. Nice cash flow for tax purposes. That $4,800 minus $3,800 of depreciation, you're paying tax on $1,000. That's it. Not $1,000 worth of tax, but you're paying tax on $1,000 in that fact pattern. So that's how.
That's massive. It's huge.
It is huge. And with one thing I want to talk about here, well, I'm gonna leave it there, and because we're gonna bring in this Tax Cuts and Jobs Act of 2017 when we talk about some bonus depreciation and such. Now, I will say one more thing, Mark. Some investors will qualify for an additional 20% federal tax deduction on top of that $1,000. So in that fact pattern, you're actually paying tax on $800 for the whole year. That's it. I'm going to talk about that QBI deduction on the 5th bullet. I'm going to make myself a note so I don't forget. I talk about this stuff all day, so it's I want to make sure I don't forget. So
I love it. So I got a question while we're on that topic of conversation. So what happens if you have more tax write-offs than actual income in a year? What do you do then?
Yeah, absolutely. So, and that ties right into the real estate professional status. If you have more deductions than taxable income, you have what's called a PAL, passive activity loss. Now, walking this back, the tax law says that rental properties are passive activities. Now, remember, there's always exceptions, right? There are some exceptions when it comes to those short-term rental properties where you are providing substantial services for, but in general, rental properties are passive activities. You could have passive activity losses, and in that case, one of two things is going to occur. One, you're going to be able to deduct that loss in the year it occurs and offset your income. Two, that loss is going to be carried forward to a future year when you have a triggering event. So one thing I'm going to point out, Mark, is we've got a link here. I know it's quite a long thing, so you're probably going to have to copy paste it. But we have a link here that takes you to a Loom video folder we specifically made for real estate investors. And they're really quick 2 to 3 minute videos just on various real estate investor topics. I did do a longer 5 to 6 minute video on when you could deduct passive activity losses.
Perfect.
And there are a lot of different tax strategies for rental grouping elections. So let's say you have one property A doesn't have a mortgage on it, and it's kicking off $5,000 of net taxable income. Property B has a $6,000 loss. In general, those are going to net together, and then you'll have a $1,000 passive activity loss that will either carry forward or it will be used in the current year. Now, there are some, with the passive activity losses in general, everyone wants to take these passive activity losses as soon as possible. One of the things I would consider to think about, first thing I said was legally and ethically reduce the taxes you pay in your lifetime. And I don't know about you, but I know a couple things are going to go up: interest rates and taxes, because they just can't stay where they're at. the Tax Cuts and Jobs Act of 2017 is going to expire in 2025. We have a new administration that's championing some tax hikes. So that passive activity loss, so that deduction might be more valuable to you in 3, 4, 5 years from now than it is now. So it's just something to consider. Excuse me. But I'm with these whole with the passive activity losses in general, you will receive some tax benefit from it. It just depends on when. Excuse me. One more thing I want to mention on the turnkey rental tax: when you sell the property, depending on it's rather complicated. There isn't a flat tax. Any depreciation that you should have taken, because we get this once in a great while. Well, I don't want to take depreciation because if I sell the property, then I have to add it back. Well, that's too bad. You need to take it. That's like getting 4 free drink tickets on Southwest Airlines, and you figure, I'll use them at the airport. No, you got to use them on the airplane. So what I mean by that is the depreciation add back is on the depreciation allowed, not depreciation taken. So when you sell a property, if you've owned it for more than a year, you'll have a capital gain component. I hope it went up. You'll have a depreciation recapture component to that sale. So there might be some other positive tax attributes on your tax return that could offset some of those gains. But again, it comes down to cash flow versus tax flow. I've had a real case client that had some capital loss carry forwards. They had a $400,000 capital gain from the sale of a property. They're considering a 1031 exchange. They're considering something complicated. When I ran the numbers, it was going to cost them $8,000 in taxes. And I thought, $400,000 of cash flow for $8,000 of tax flow, and you don't have to tie any of the money up. Why don't you take advantage of those capital loss carry forward? So everyone's situation is unique. Even though I'm going to give you some advanced strategies here today, we firmly believe in diagnose, then prescribe. Okay, diagnose, prescribe, and we have a whole system and process for doing that includes color coding, and we apply what we've internally developed as an IQ test: identify, quantify. Because you could wipe out all your tax, but once you get down to the 12% marginal tax bracket, or even the 22, sometimes it's better to not spend that cash to get down to that level, and maybe use those deductions and those positive tax attributes in a higher tax year. So, but you dovetailed into the rep, real estate professional status. Big picture, because we could do an hour to 2 hours just on that, right? If you're a real estate professional or your spouse is, what that does is that it allows you to consider what we just talked about. Those passive losses are now deductible, okay? And how do you get to real estate professional status? In general, you've got to meet the following criteria. 1, you have to spend at least 750 hours in real estate activities. There are certain activities that are qualified for real estate investor activities. In general, it's going to be, I've got a whole list in the video, but you have a link to, but it's going to be acquisition, rehabilitation, property management, brokerage, investment. Anyway, 750 hours is the easier of the 2 main criteria. 2, those real estate activities have to exceed more than 50% of the professional time that you had the year before. So in general, it's this, most of you may have probably heard of it, 750 hours, more than 50% of your professional time in a year. Now, one thing I will say about this professional time to consider is, and we have 3 children, 12, 11, and 8 years old. Being a homemaker does not count as professional time, although I will tell you, I would much rather do my CPA work and my real estate investing. I love my children, but I would probably be a terrible homemaker, and that's the hardest job we have out there. But so a lot of times what happens is that we have one spouse that might be a very high W-2 earner. The other spouse is a homemaker, or a student or doing something, but usually it's a homemaker. That for the homemaker spouse, all they really have to do is get to that 750 hours, because they don't have another quote unquote job. It's real hard for a full-time W-2 person to have that, to make it. There are also some rules about counting your time in your W-2 job. It depends if you own a portion of the company. So again, I don't want to go down. Like I said, we could really do hours and hours just on real estate professional, but that's a lot of times what happens is that the homemaker spouse starts getting involved in the real estate and the management, the keeping track of the properties and working with the property management company. So it's a lot easier sometimes for a homemaker spouse to qualify as a rep. And if one spouse qualifies, the other one does. So we're kidding around, actually. Oh, go ahead. I'm sorry.
Yeah. So, and then just to chime in here. So then technically, mark me if I'm wrong, but then that means if there's extra passive losses, like we talked about before, then instead of just carrying them forward to a later year, if someone in the family is a real estate professional, like the spouse you're talking about, well, then you can use those losses against the W-2 income to lower the adjusted gross income of that W-2 of the whole family, essentially, since you're filing your taxes jointly. And then, that could potentially knock you into a lower tax bracket, right? Isn't that one of the best benefits of doing it?
Exactly. That's a huge benefit. And so I will run through a couple of misconceptions. You don't have to be, excuse me about my voice here, but you don't have to be a licensed real estate agent to be a real estate professional. Real estate professional is a tax designation, not a license. Now, if you passed your real estate, exam or your broker exam, those are positive traits. Those are positive facts, but it doesn't make you a rep. Conversely, you don't have to do that to be a rep. It's a facts and circumstances situation. My advice would be, definitely, use your calendar to document the hours that, at least then you would have like all your meetings that you're doing. Just once a day, kind of just jot down on what you did that day as far as keeping track of the hours. You don't submit these hours when you file a tax return. They're part of the documentation and support needed when a tax return is filed. In our software, it's literally clicking a button and saying, I'm a real estate professional. There's not even a tax selection that you really make. It's just, you can add that verbiage to the tax return, but it's as simple as that. So,
right. And you can also use the time analyzing deals, right? Looking for the next acquisition, that counts. So just scrolling through Zillow for 750 hours, right?
Yeah, exactly. Let me, if you could, sorry, I'm going to pull, what? Sorry about that. I was going to try to pull up those activities that count, but I'll send it out after. No problem. We'll get that in the chat, the link to that video. So absolutely. On that real estate professional designation. So there's some big advantages there. And a lot of times you will then, a lot of the more advanced tax strategies make more sense to you. So now the next one, so I already talked about diagnose, prescribe. We have 4 different color-coded diagnoses based on your situation. Once we have your diagnosis, then we come up with some prescriptions. And a lot of tax planning strategies. I mean, there's tons of different strategies, but I really wanted to hit on the 3 that are the best bang for your dollar that I've seen for real estate investors. So the first one is a cost segregation study. I'm going to take you back to our example. All right, let's bring our friend over here, where we had $104,000, I believe, of building. Okay. We're going to put this to the side for a second, and because I kind of skipped over something. on the cost segregation studies, what happens is I already mentioned on a single family property, whatever the building portion of that property is, around 80%, you deduct that over 27 and a half years, on a straight line basis, meaning it's the same amount of depreciation every year, okay? We use the term depreciation because that's an accounting term. But when it comes to real estate, it's a term I try not to use because we buy real estate because it's going to appreciate, not depreciate. So it gets very confusing, right? So we sometimes call it our cost recovery system. So think about it like our cost recovery system for the purchase of the property is 27 and a half years residential. Remember, it doesn't matter if you paid cash. It doesn't matter if you have a mortgage. It's irrelevant. All right. When you, because that's what it was, a rather real property is 27 and a half years. So with a cost segregation study, what happens with a cost segregation study is that you take a property and you separate out, okay, the tangible personal property portion of the real estate. So quite the tongue twister. What in the heck does that mean? Okay, speak English. What that means is that a portion of that real estate you purchased is going to qualify as a different asset class that could be depreciated or the cost recovered faster than 27 and a half years, which is very advantageous. That includes, but not limited to, because I don't want to try to remember everything, your windows, landscaping, your heating and cooling systems, your electrical systems, the furniture, fixtures, whatever, so that all of that stuff can be most likely depreciated or cost recovered faster than 27 and a half year. And depending on what you have, it's going to fall into categories of 5, 15, or 5, 7, or 15 years. All right, so wouldn't you rather write off a portion of your property over 5, 7, or 15 years instead of 27 and a half? Well, of course you would.
Mm-hmm.
In general, we're talking in generalities, 20%, typically 20 to 30%, but 20 to 30% of your property, of your building, let's bring this back over, on the single family home, $140,000 is going to qualify for quicker depreciation. Let's go 25% of 104,000 is $26,000. Now I am going to jump to that final point real quick. Because of the Tax Cuts and Jobs Act of 2017, real estate investors now can take bonus depreciation on any 5, 7, or 15-year asset classes that are in part of the property. What's bonus depreciation? I'll make it real easy. You get to deduct it all year one. So in this fact pattern, all right,
Massive.
you bought that property, you'd get a $26,000 tax deduction year one on that single family home.
Massive. This is one of the reasons why we buy real estate, just for that. The bonus depreciation year one immediately to reduce your adjusted gross income. That's one of the reasons to do it. That alone. As long as, mark me if I'm wrong, you have to be a rep, right? A real estate professional status to take advantage of that, correct?
Right. Great point. You do not have to be a rep to do the cost segregation study. You would have to be the rep to take a deduction for the entire study year one, if that makes sense. But Mark, let's think about this. You're a wealthy, I don't know, not accountant, right? Probably a lawyer or doctor, what the heck. In California, okay, you've got a marginal tax rate of 40% or more, and it's only going to go up, okay? Even, and you have a lot of cash, you don't want, let's say you don't choose to just pay cash for all your properties. You buy this property. We already talked about the cash flow being about $4,000 per year, net cash flow. Well, if you didn't have the mortgage, your net cash flow would probably be about $500 to $600 per year, okay? So let's pretend, and there's a reason I'm going through this. Let's pretend you, in that fact pattern, your net taxable income from that property is $4,000 a year. All right.
Mhm.
You do this cost seg study, you get a $26,000 immediate deduction, divide that by 4, you have 6.5 years of tax-free income. So I still would make an argument the cost seg study would make sense just based on that. Just based on that.
I love it. Yeah, exactly.
Especially-
And that's for anyone. You don't have to be a rep status for that.
Exactly. That's why we're working on some advanced calculations to figure out if it makes sense to take the bonus depreciation, because bonus depreciation, you can't take it with you. So my point is, if you were a mature age person investing in real estate and took a crud load of deductions right now, when you pass away, your beneficiaries, if you do the right planning, will get a step up in basis to the fair market value of that property and get to depreciate the entire property all over again at a higher value. And all that bonus depreciation never gets added back. So the cost segregation study is not just for rep status. It's really for anyone that wants what we call gold diagnosis, tax-free income and growth. Think about the power of, even if you paid cash for a property, your ROI on that property might be, I'm just making a number, 8%, right? And I don't want to say what it is, but if you can get 6.5 years of tax-free 8% annuity when you're in your highest earning years, that's great. So, yeah, but you nailed it. Only a rep is going to be able to take the entire benefit of the cost seg study year 1.
I love it. I love it. Yeah. So anyone out there, if you guys need a referral to a company that can perform a cost segregation study, please reach out to me. I'm happy to send you a warm introduction. And just like Chris said, he recommends everyone gets a cost segregation study, whether you are a brand new real estate investor or a full-time real estate professional.
And yep, I would do the cost. And it used to only make sense if the property is over $500,000. Right now, you have some resources, and we've got some resources that can get that done effectively. Now, I want to point out one more thing before we get to the next two. Mark, it happens all the time. Oh man, I bought this property in 2019 and I just took the regular depreciation. Well, guess what? You get a get out of jail free card. You can actually go back, do a cost segregation study, pretend you did it in 19, and whatever you should have taken in 2019 and 2020 as depreciation, had you done the cost seg study, you would get in 2020 or 2021. We have clients that are on extension. You probably know, Mark, about half our clients, we do extensions on purpose because I want to see how the numbers lie and determine, should we do the cost seg study and count it for last year? It's called a 481A adjustment. I don't want to get too technical. We have a video in our library, but don't think that cost segs just for current year properties. We always, what we call scrub a tax return to figure out, is there low-hanging fruit that we can pick up immediate deductions.
Wow. How many years can you go back and retroactively do the cost seg? What if I bought a house in 2010?
You could, but what's going to happen though is that Tax Cuts and Jobs Act and the bonus depreciation one isn't available in 2010. So the benefit's not going to be as high, because a lot of the 5 and 7 year property you would have, I would tell you, Mark, in general, if it's the clients that have owned property for 10 years, it can be worth it, but it's typically going to be commercial real estate with at least a building value of $500,000, because the commercial real estate you're renting off over 39.5 years. So if you've got, we've had it where you go back 10 years.
Wow.
It's just, we didn't have that bonus depreciation on the 5, 7, and 15 year assets then.
Wow. Either way, it's good to know that it's not lost and you can go back. That's exciting.
All you have to do is this: work with someone. It doesn't have to be us. Like I said, there's a lot of great people out there that know what they're doing. Work with somebody that can do what we do, is we do a cost benefit before you pay for a segregation study. And Mark will, any good segregation company, cost segs company is going to give you that cost benefit before you pull the trigger on it. So, yeah. Strategy number 2, most of you've heard of 1031 exchange, tax deferral. So you're deferring the tax on that property. You're preserving your cash flow. You do have to invest you have to go buy a replacement property for at least the value of the property sold, and you can't take cash out of the deal to do a full 1031 exchange. But 1031 exchange is a really good advanced tax strategy. It's something that takes a lot more planning than the cost segregation study, because cost segregation study, you have that get out of jail free card. The year of acquisition, you have until you file your tax return to actually do it. So if you bought a property in just February of 2021, you really have to file your 2021 tax return, which would be up to October 2022 to do the cost seg study year 1. 1031 exchange takes a lot more planning, but what I would mention to you is that what I've watched is an uptick of more advanced 1031 exchanges. And so, in fact, let me give you an example, Mark. Let's go back to our rich doctor in California. Rich doctor is retiring. He sells his commercial building that he operated his medical practice out of. He goes and buys 8 to 10 cash flow properties with that money. It doesn't have to be one property for one property.
Mm-hmm.
The like kind exchange is there's a loose interpretation. And I've had several clients sell one property in California and buy up to 10 properties here in the Sun Belt in the middle America.
Mm-hmm.
So
yeah, we've seen a massive uptick in 1031 exchanges just because of the benefit that they provide. You can also you can do a 1031 exchange. You can go on the single family side and you can go buy a 30-unit apartment building, right? You could do that just like what you were saying. You could sell your multi-million-dollar commercial practice and go buy a multifamily apartment, right? It could be a multiple single families. And the big one with the 1031 is just knowing that the number one place where we see people screw up is that you need to call a 1031 intermediary before you sell your subject property. That's just the holy grail, right? You don't get a get out of jail free card. You can't go back to and retroactively complete this. And those individuals, more than happy to send you another referral. Please reach out. We've got some great 1031 intermediaries, just one extra person you need to reach out to, but just make sure you do it before you sell the current subject property.
Exactly. No, it's a great point. And you've got to really, it's a good, awesome strategy with the right planning. It's very effective. The last one I'm excited about. I'm going to be creating some content, another video on how to walking through how to do this. But here's my thought. We talk about cash flow versus tax flow. What I run into, most of our clients want is they want additional liquidity to expand their real estate portfolio. But they don't want to sell their first instinct is, well, let me sell something. Well, if they have good properties, they want to keep them. So pulling cash from your portfolio tax-free is a great way to increase your cash flow without triggering tax flow. Think about it like this. In general, anything that's going to hit your personal balance sheet is not going to be taxable. Taking on debt is not taxable. Paying off debt, conversely, is not a tax deduction. It's the interest that's deductible. So let me give you an example. Let's say you buy distressed property. A lot of it is, think of Burr method, or you buy a property for let's go back to our property.
Well, let's just do this example. We've got multiple clients that are going through it right now. They bought a property a few years ago in Memphis, Tennessee I'm actually working with someone right now, bought a property for $100,000 in Memphis, Tennessee, just 2 years ago. And now it is worth about $125,000 just 2 years later, right? So what would you do then?
Okay, in that case, what I'm going to say is, as long as if you take out more cash put a mortgage on a property and that mortgage amount exceeds the amount of that you paid for the property, then you might not be able to deduct all of the mortgage interest, but there's no tax on pulling that cash out. In your fact pattern, it's going to be different. You paid $100,000 for it, right?
Mm-hmm.
It's now worth $125,000.
Mm-hmm.
Okay. Let's say they paid cash. Maybe it doesn't really matter. Let's just run through this example. Mark, I know you work with awesome lenders because I've met them at the other summits. But let's just go with the 80% loan to value. I know it.
Let's
it's
do
all
75%. That's what we're hearing these days.
Okay.
75%.
75% loan to value. So you could take out up to $93,750 on that property. If you don't have a mortgage on it, that's almost $94,000 of tax-free cash flow, zero tax flow. Let's say you already have a mortgage of 60 grand. Okay, fine. You're refinancing, you're pulling out 33, 34 grand. Maybe you could put that down in another property. So you just expanded your portfolio without spending more cash.
Yeah,
right?
which is absolutely massive. And that's one of the big recommendations that we have for our clients here. Is they try to make the decision, you know, do I buy a bunch of cash flowing properties today that maybe are in a C-class area that hasn't been appreciating as much as buying maybe less properties in a more expensive neighborhood with more homeowners that has a better chance to appreciate. And the reason some people like to go and buy less properties in better neighborhoods is this exact strategy that Chris has, is you let that property appreciate, you pay down some of the mortgage, and then you do a cash out refinance at roughly 75% loan to the new value, the current today's value of that property. And as long as you do the math properly, there will be capital that you can pull out tax-free to go put towards a down payment of another property. So all you really need to do is just wait until that amount of cash that you can pull out is enough to go do 20% down on your other property. So essentially you can double the size of your portfolio just by doing Chris's strategy. I love it.
I was just jotting a note down, Mark. Think about this. Diagnose, prescribe, right? So this is not a prescription until your CPA or us diagnose you. But let's look at this. Let's look at your fact pattern. Let's say someone did have a $60,000 mortgage on the property, which is reasonable if they bought it a few years ago. They pull out 33.7, right? Which 33.7. Okay, they can go buy another property. Let's see, 33.7. They can go buy another let's say they go buy another $130,000 property. Fair enough. They're still going to have $5 grand in their pocket, plus $130,000 property, 20% land. 131. What if they go buy that property, do a cost seg on it, and get another $25,000 tax deduction?
Yeah, all just strategy, all without spending more cash. Yeah.
Cash flow over number 3. This is such an important piece that a lot of people ignore. I want to circle around one more because I know we're going to run a little short on time here, but I discussed how turnkey rentals are taxed. If you qualify, you could potentially count your net rental income. So if you don't have a passive activity loss, if you have net profit from a rental property, and you might be able to get that qualified business income deduction for that property, there's a special tax election you would make to treat your real estate enterprise as a business. You still, because net rental income, not only are you taxed on the net amount, we talked about number 1 of the tax strategies, net rental income is not subject to self-employment tax like W-2 wages. You could treat your net rental income as qualified business income potentially and get a 20% deduction on that. That's typically when you have a property that's, you know, maybe a short-term rental, or maybe you don't have a note on it, or you've expired your depreciation and you've had the property for a long time. So I just didn't want to, I didn't want to forget about that, because
Love it.
That hits our last thought. What part of the Tax Cuts and Jobs Act might be gone? Let me think. I wish I had a crystal ball, because I don't. If I did, I would probably still do this because I love what I'm doing, but I would be in Las Vegas right now.
Sure.
So what's going to change? Well, here's the thing, guys. We have to understand that we had the buying real estate is a very favorable and well looked upon activity and industry with our tax code. We just had a president that is a huge real estate investor, and now we have one that is talking about taking away some of those benefits, most namely the 1031 exchange if your income is too high. I would say the one I don't think is going to go away for sure is the Section 121 exclusion, which is if a property was your primary for 2 of the last 5 years and you sell it, you don't have to pay tax on up to $500,000. Why? That was put into place because that's exactly what the people in the House of Representatives do. They move to Washington, live there 2 years for 1 term, they sell their house there and don't have to pay tax on it. And that's kind of a bipartisan deal.
Sure.
My gut feeling right now is that anything could happen, but I feel like there won't be a ton of retroactive changes here for 2021. And then 2022, we have another midterm election coming up. So, this Tax Cuts and Jobs Act is in the books till 2025. And, everything is up for change. I would just say, I wouldn't overreact just yet, and let's see what happens. And you have to understand too, when you're talking about real estate, I mean, you have the Bankers Association, the mortgage folks, National Association of Realtors is one of the most powerful organizations in Washington. So there's a lot of things to jump over before something actually gets repealed. So I know that's not the very detailed answer that you might all be looking for, but the point is, make sure you're working with someone that you can, talk to throughout the year to determine how things are going to change. And I will say we've had, over the last 18 months, 3 major tax law changes, and usually we get 1 every 4 to 5 years. So we've been drinking water out of a fire hose, and we're as a CPA community. And just because something is proposed to be changed doesn't mean it's going to actually get changed. When you look at in a lot of these changes, it takes a long time. I mean, I'll give you an example of PPP came out in March. It was December 28th, I believe, and I think that's my wedding anniversary. That's why I remember this date. It's either 20th or 29th. 9 months later, finally, we had a final decision that if your PPP funds were used properly, they're tax-free and you still get to deduct those expenses. 9 months. And because Congress and the IRS couldn't agree on what the intent of the law was. So I'm just throwing that out there.
Yeah, no, I appreciate you, touching base on that. And the big one was the 1031 exchange. So if you do own a property now, if it has gone up in value significantly, now may be a good time to sell that property and realize your gains, and then move that into something that cash flows. Definitely something, to be aware of. But then also on the opposite side of that, they have been threatening to get rid of the 1031 exchange for over 100 years now. So I've heard, and it's something to where it's still here to this day. So we don't know, but either way, it could be a good thing to look into.
Yeah, I think one of the things that's been talked about a lot is that step up in cost basis going away. But again, I just don't see that I mean, the reason I personally don't see that happening, and I could be wrong, is it's very difficult to keep track of your basis. It's hard enough for someone that's alive, if their accountant wasn't really good, sometimes for me to get the basis of their assets, let alone, can you imagine you inherit something from a grandparent or your parents, trying to figure out what their cost basis is on anything? It's going to be challenging, but a few things I want to leave you with. One is and I'll put this as a long link, I'll put it in the chat. This takes you to our folder for a bunch of real estate investor videos. We do have a professional Facebook page. We have weekly posts, and I post a lot of different stuff, and it's right here. It says facebook.com, but Your Real Estate CPA. And then if you're interested in learning more about our firm, about being a client of our firm, these are absolutely complimentary. Just go for it. Just go to realestatecpa.guru, and then you can put in your information and we'll reach out. We do operate a little differently than other firms on a membership-based subscription model. But I'm not worried about that yet. What I can promise you is if you're attending this event and let us know that, then I'll make sure I guide you in the right direction, and we'll go from there.
Yeah, well, great job, Chris. Definitely appreciate you. And, you know, in summary, I can definitely vouch for him because he's my personal CPA as well. And I can definitely remember the first time that I actually had rentals, the first time I was able to use Chris, and I didn't know exactly what type of tax burden I would have to pay that previous year, right? So I just saved as much as I could, you know, to be able to be ready to pay the government, right, when that day came. And I'll never forget when I reached after that first final appointment with Chris, sitting there at Chick-fil-A, talking to my wife, just jumping up and down for joy, because I think I saved twice as much as I really needed to actually pay because of all the strategies that he was able to implement. And I didn't think it could be fun to actually pay taxes, but that was one of those instances where I was fired up and thrilled that he was able to reduce those taxes for me by such a high amount. So if you need any more information from Chris, please, you know, let us know. You can definitely reach out with those links there. I can get you his cell phone number as well as his email address, so you can reach out anytime. And yeah, we appreciate you. Thank you very much. And hope you guys found some value.
Thank you. Have a great rest of the day.
All right. Cheers, guys. Hey guys, Mark Hart here from MIP. Welcome to the next session for the 2021 SOFA Summit. This session is called the Property Deep Dive and Neighborhood Tour. First, we're going to start off, and I'm going to take a deep dive into one specific property. We're going to go over the Google Drive folder, and in this folder, this is the marketing material that you'll be able to view on your own for every single one of our available rental properties. So this is the information that you'll use to make an educated decision to see if you'd like to move forward with the home or not. So I just kind of want to walk you through it from our perspective, just so you can understand it a little bit better. And then once that's completed, we're actually going to go visit Sean, who's actually at the property. He's going to give you a little walkthrough of what the home looks like before renovation, so when we actually bought it. And then you can see the finished product as well. It's great to see that transformation. And then finally, best of all, we want to bring Memphis to you. So we're going to drive around the car a little bit so you can actually see the tour of the neighborhood. So you get to know the difference between an A, B, or C class neighborhood here in Memphis, Tennessee. Let's dive in. All right, first things first, love to pull up Google Maps. We're going to dive into an A-class neighborhood, which is actually across the border in Mississippi. You'll see a lot of addresses in Mississippi, and I want to let you know that it's not a completely different market, right? It's not 3 hours away. It's not a plane ride away. It's actually still a part of the MSA of Memphis, Tennessee. We're just right there on the border between Mississippi and Tennessee. So you can drive from one property like the Mill Branch property that we just analyzed the other day, and as if you're going through a different neighborhood in a different suburb, boom, all of a sudden you're in Mississippi. So we love investing down there in Mississippi. It has a lot of pros. It's even more landlord friendly down there. There's incredible public schools. That's what the tenants really like. There's a lot of jobs, whether it's white collar or blue collar jobs. So tenants will be able to drive to Memphis to work maybe at the airport or downtown, or they'll just stay in Mississippi and work there as well. It was actually one of the fastest growing counties in the entire United States of America a couple years back. And it's definitely the fastest growing county in Mississippi still to this day. Then what we also love about just the Memphis market and Mississippi as a whole is it's the fastest growing industrial market in the entire United States of America, which just means building more distribution centers so people can ship packages, which is a major trend in a post-COVID world. Well, the question is, where within Memphis, Tennessee is that actually happening? And shockingly enough, the majority of these new construction, distribution, ground up facilities are actually happening down in Mississippi because there's a lot of buildable land down there. So a lot of new jobs, great public schools, very landlord friendly laws. From a downside perspective, there is income tax. So that is something that you'll have to just factor in when you're doing your taxes on an annualized basis, as opposed to Tennessee, which does not have an income tax. So the property down here is going to be located in South Haven, Tennessee. When you're diving into the Memphis market, the farther east you are, normally the better. So if you go to the east, you'll see Olive Branch over here. That's an even more expensive, affluent area. We build a lot of houses, new construction properties down there. Then South Haven, still an amazing area. And then you'll have Horn Lake a little bit to the west, which is more of a B+ type of neighborhood. It's always great to click over here on the left-hand side and drive the streets with good old Google car here, just to take a little 360 and kind of see what the neighborhood looks like. We will be able to go drive this neighborhood with Sean after this. All right, so let's pull up the Google Drive here, or our due diligence vault, where we keep all the marketing material needed to make an educated decision to see if this is a rental property that you would be interested in moving forward with or not. At the very top here, this is where you'll see our folders of photos. When you see this property available, you'll only see the pre-renovation photos. So we want to let you know that the property is under construction. It's not the final product. But once you are finished with once we're finished with the renovation, we'll add progress photos as well as professional photos at the very end for you to view. So after this, we will be able to go on site and actually check out the property in person. First things first, always like to look at the numbers in the pro forma. It is an investment rental property. Price here, $177,900. That does include the renovation. 4-bedroom, 2-bath, 1,600 square feet. What we love about Mississippi is, since it's a newer community, essentially the properties are normally a lot newer as well. So this property here is built in the 90s, which is really rare for us, since most of the properties in Memphis are built in the 50s and 60s. It's always more advantageous to get the newest possible property. Normally it just costs more, so you get a little bit less cash flow, right? So that's where you gotta, make that balance between what your goals are versus what type of cash flow you'd like to receive. Next up, target rent $13.95. Once again, we're able to rent these properties here in Memphis, in Mississippi, actually faster than Tennessee, which is great. This was the first area, all of Mississippi was the first area where we had a wait list for tenants, meaning we ran out of available rentals and we had too much demand from new potential tenants. So that's what's really great about the future, from a long-term rental perspective, is just because of the jobs and the schools. Check out the crime maps or lack thereof. People really like that. It's just one of the many reasons investors or tenants like to live there. So then this property here is a 6.28% cap rate. That's the ROI you'd get from a cash flow perspective if you paid in cash. But since most of our clients will use financing, conventional mortgage, or 20% down, your net cash flow after all expenses, maintenance reserves, vacancy reserves, property management fees, after everything, is projected at $284 per month. And that is pure projected profit that you can go spend on vacation or hopefully another rental property. I do want to make note, though, that whenever you see vacancy losses up here, this is just a financial projection, right? This is not the flow of capital. Essentially, the flow of capital is we're going to collect the rent of $13.95. Then we're going to take out our property management fee, which is $107 per month. And then what we'll do is you're going to get the rest of the money. right? So you're going to get the vacancy loss of $56. You're going to get the $70 for repairs. We just want to educate our investors to let them know that's not pure profit, right? It is cash flow, but there is going to be a day down the road in the future when you need to actually use those expenses. So that's why we recommend having another actual account to build up your maintenance, vacancy, and CapEx reserves. But some clients, they like to have access to a different pool of capital and then use this repairs of $70 and vacancy losses of $56 as actual cash flow. So everyone has a different, strategy there, but you could potentially add in around $124 on top of the $284 per month. So just another way to think about it. The cash on cash return is projected at $3,411. This is per year. That's an 8.8% return on investment. Now, once again, this is all the cash that it took to buy the investment, the down payment plus closing costs of $38,830 divided by your net cash flow, or projected at $3,411. The big ones is always make sure that in your net cash flow, you take out vacancy losses and maintenance reserves. And for cash invested, you always include closing costs. That's very important because it can skew the numbers one way or the other. And it's always good to have a realistic expectation. Property price appreciation, $4,448 per year projected. And that's only at a 2.5% appreciation rate. Mississippi is appreciating significantly more than that, 8s, 9s, 10s plus, just last year alone. Then the tenant's paying down your mortgage, $2,685 per year. And that's year one. That gets better every single year as you pay less interest and more principal on the amortization schedule. And then your tax savings ROI, always consult your CPA on those because everyone's status and income is a little bit different. And that's a projected return of $11,669 year one. And if you divide that number by your initial cash invested of $38,000 and change, that's about a 30% ROI year one. And incredible. A lot of people say, how is that even possible? Being a passive investment. And ultimately speaking, that's just the benefit and the reason why you have companies like Blackstone that just went out and spent $6 billion to buy 17,000 rental properties. Let that sit in one more time. Blackstone just a few months back bought 17,000 long-term buy and hold single family rental properties just like this property here. So, I'm not the smartest person in the world. Blackstone, they are brilliant, and we're just following in their footsteps here. We're not reinventing the wheel. We're just being replicatable and duplicatable and trying to make it easy for you guys out there. Next thing, always like to dive into the scope of work here. This is going to be one of our full renovations. It's got a new roof, new heat, new air, new water heater as well. And new means we are spending the money to renovate and install that item. Sometimes you may see roof approximately 2 years old. And what that means is that when we bought the home, the roof is approximately 2 years old and we're going to leave it, right? So you'll either see approximately 2 years old or some age, or it'll say new. A living room, kitchen, bedrooms, hard surface. Once again, I would never buy a rental property that has carpet on the main floor. It is okay, in my opinion, to get carpet on the second story because we get a lot of complaints from tenants. If you put hard surface floors upstairs, well, then when a tenant is walking around, it can be really loud and noisy on the main floor. So it is okay to have carpet on the second story. But on a single story house, always, always, always get hard surface, whether that's tile in the wet areas or luxury vinyl plank in all the other bedrooms and common areas. That's the most common here in the Memphis metropolitan area. From an appliance standpoint, we are installing a dishwasher. We're not going to install a stove. The tenant will bring that. We are installing a vent hood. And we're not installing a refrigerator. The tenant will bring that as well, in addition to the washer and the dryer. Over here is when we expected the property to be done with renovations. Once again, this is construction, so that number can definitely vary. And then here's some more frequently asked questions here. We dove into the first half here, so let's start with the second half. The next one is the rents are target rents. When you move forward with our properties, they're still under renovation, they're vacant, we're looking for a tenant, right? So that rent could change. But the one thing that we do as a firm here is, let's say the rent's $1,000 and we need to lower it to $975 to be able to get a tenant in place. Well, we would take that difference of $25 and multiply it by 12 and send that money to you in a check. So essentially the first target rent that we have on that pro forma is what you will be receiving. Now, we have so much demand here in Mississippi, here in Memphis, Tennessee, that as of filming this video here, every single one of our properties in our pipeline, by the time the renovation is done, it's already rented. And that's just an incredible statistic and a big accomplishment to our in-house property management company, Reedy. Next is going to be the property management fees. Always good to go over. The Reedy & Company charges 8% of gross collected rents for the monthly PM fee. Normally, it's actually 10% of gross collected rents. That's actually the market rate here in Memphis. And we are able to give you a little bit of a discount if you buy a property through myself at MIP. Then we also have a $250 annual renewal property management fee. So that's per property per year moving forward. Then all properties are marketed towards Section 8 and conventional tenants. This is actually a federal law. If you're managing the property yourself, well, and it's just you only have one or two properties, well, then you can technically discriminate and pick your own tenant. But for us, what we do is we set a bar, leasing standard essentially. And the first applicant to pass the bar, pay their down payment, and sign at the dotted line is the one that actually gets the property. As of today and filming this video here, we actually have very few Section 8 tenants. The ones when we do get Section 8, it's normally closer in the C-class neighborhoods. And even then, it's a much smaller number compared to the conventional tenants that we have. If the home is vacant upon closing, a lease-up fee will be deducted from the first month's rent. The lease-up fee is half of the rental amount. If already rented, we will waive the fee, which happens 90% of the time. So this is exactly while you're buying the home from us, Reedy is managing the property. And that means they're looking for a tenant. And if we find a tenant for you before you actually close, then we'll waive the leasing fee. So it's just one way to reduce the expenses. But if you close on it and it is vacant, well, then you will be subject to the leasing fee of 50%, the first month's rent. And as of filming this video, the pipeline currently, they're all rented. Statistically speaking, it's close to that 90%. So right now, there's a massive amount of demand for rentals in the suburbs because of COVID, right? It's caused a big exodus away from the city so people can move to the suburbs and have more space, right? If you're going to work at home, if you don't want to be around a lot of people because you don't want to get sick, it's great to be able to have a yard and a little bit of space to relax. All right. We also have a $500 maintenance reserve that's required for each property. What that basically means is we're here to, number one, make sure that our tenants are happy and stay a long time. And one of the ways to do that is to perform maintenance as quickly as possible. And we are very fortunate that Reedy & Company is a management company, but also an in-house maintenance company as well. So that means Reedy hires hourly and salary employees as opposed to slapping on a markup on someone else's work and just scheduling the repairs for a third-party plumber, electrician, etc. One of the ways we to quantify that, a water heater for us is $995 and our competitors charge $1,300 down the street, right? Massive savings there. So essentially, if we go into the property and we see the toilet is clogged up because of the maintenance repair, a request that came in from the tenant. They have a little portal that they can log into. If the repair is under $500, and let's say the toilet's rusted out, just normal wear and tear, well, we're just going to go ahead and make that repair right away because we want to benefit the tenant, right? We want to get it done quickly. To them, they don't care who the owner is. They just want it fixed. So if we can get it done quickly, that makes them really happy. But if the repair is over $500, that's a little bit too much money for us to just spend of yours. And so we will just document everything that we learned, send you an invoice with a description and photos so you can make the decision. And by decision, if you say yes, well, then you'll pay for it just like you would doing any maintenance on your primary residence. Now, the caveat to that as well, let's say we went there and we found a Barbie doll shoved down the toilet. Well, that bill, you wouldn't see that. It would go directly to the tenant's ledger and they would have to pay for that in addition to their rent. So it's always good. We're always looking to see, is it tenant damages or just normal wear and tear? All right. We will, for a nominal fee of $75, an annual inspection will be held for each property. So we want to make sure that there isn't any major deferred maintenance caused by the tenant, right? And so to do that, we go into the property every single year to make sure that they're taking good care of the home. We want to look for major lease violations, like do they have pets in the property? Are they taking good care of the property? Like what is the condition of the home? Also, we want to make sure that it's safe in terms of there's batteries in the smoke alarms, there's fire extinguishers. We check the HVAC filters as well because we want to make sure that that lasts a long time. Then we do have additional preventative maintenance programs. You can click here for more details. We can help prevent with termites, with the HVACs, and additional cleanings in the fall and in the spring. And then finally, you'll see the two big names, right? Reedy and Company and Memphis Investment Properties. And we just want to let you know that they're both owned by Jim Reedy himself, just under different entities because they serve different purposes. Then next up, we do not recommend that you lock in your rate until after your appraisal and home inspection. So if you're buying the property and you're going to get a mortgage, you may be inclined to lock in your rate as quickly as possible because we are entering what we believe an environment where rates are rising, right? And so essentially what that means is that you only have a set period of time to close on the property. Otherwise, you could be subject to fees. And we just want to let you know that this is construction, right? There's always delays. There's no sure thing until it's officially closed. So if you do lock in the rate, we recommend, not doing it until after the appraisal and inspection when you're ready to close. But even if you do want to do it earlier, that's okay. You can. It's just we can't go any faster, right? And if there are additional rate lock fees, that would fall on your own expense. Then the 10% late fee is kept by Reedy & Company to pay for the collections team. So if the tenants don't pay rent, we're not going to charge you that 8% fee, right? We want to make sure our goals are aligned. That 8% is on gross collected rent. So we only make that money when they collect the rent. And so essentially to assist, so Reedy is out the funds just like you are, and our collections team is working overtime to actually get the late fee. Hence, that's where the 10% would go when it gets collected. Because we have 4 individuals on the collections team. They're amazing. They'll email, call, text, mail, show up physically to the property to do everything possible to collect the rent. And then finally, once the rent is collected, it will be deposited into the owner's account on the 6th business day of the following month. It is collected along with the monthly profit and loss statement. So essentially every single month, assuming the rent gets collected, we will deposit it into whatever checking account you'd like. And 2, we'll send you a profit and loss statement so you can quickly be the asset manager of us and see how the entire portfolio is performing. And then boom, on to the next month. All right, so that was the FAQs. Down here in South Haven, Mississippi, there's really great schools. So that's where we pulled these from greatschools.org. You can also see them on Zillow if you want to check. 6s out of 10s, 5 out of 10s, and that's really good. And we're really proud of that. And that's one of the reasons why the properties rent so quickly. Of course, you have the purchase process checklist here. If you want to follow one by one, have at it. And then finally, here is the home inspection report and punch out list. This happens after the renovations are completed. And this is exactly where we will, one, take all of the recommended repairs, whether it's 5 to 10 items, and give that report to our construction team. And they're going to make almost all the repairs for free at no additional cost to you. Now, if there is 1 or 2 items that we don't do, it's because we wouldn't do it on our own property. So that's it. Avery Jordan in South Haven, Mississippi, in an A-class neighborhood. Now let's go see Sean and actually go check out the property so you can see the renovation as well as a neighborhood tour. Have a good one.
All right, hey guys, Sean Taggy here. We're checking out another property. Today is Monday, February 8th. It is about 43 degrees outside, so a little chilly for Memphis. That's pretty cold for us over here. Yeah, so we're at 317 Avery Jordan Cove. It is in South Haven, Mississippi, so just about a few minutes down south of the border from the Tennessee-Mississippi border. Yeah, so this is a great little house, great little neighborhood. And a nice little quiet cove here. You'll see a little drive around the neighborhood later on, but we're gonna show you the before on this property, what it looks like when we get started on our renovation, and we're gonna roll through the during and after later on, so you can kind of see our full turn on this property. So let's go out on inside and check out the property. All right, come on in. So we just bought the house and we have our crews rolling on the house today. We're getting the security doors, the new locks changed and everything like that. Pretty decent at purchase, as you can see on this property. We already have a dumpster in the front yard rolling on the property, but we're changing out the light switches and the plugs, as you can see like that. Nice paint coat on here, some trim done. So it's pretty rolling along on our renovation. And every house is unique. We kind of just adjust with the property and renovate as needed, the things that are needed on the property, and depending on the rent amount in the neighborhood, everything like that, we adjust to try to make it like the best looking house, the best looking rental property in the neighborhood. So this kitchen's actually looking pretty great. Looks like we got new Formica countertops in here, kind of look like a little bit of granite from afar, that color. These cabinets are already pretty good shape, so we're just gonna keep them how they are. This is a great little rental, got a fireplace, nice little den. That's the front door right there, kind of walking into here. A newer built house. And yeah, I really like this. This will make a great little reno. Looks like a lot of the capital expenditures are in pretty good shape as is right now. All right, let's just pan around to this first bedroom here. So this one has carpet in it when we bought it. It's actually in really great shape, this carpet. So I think we're just gonna clean this up and go from there. We'll see. So we're kind of, as you can see, just barely started on the renovation. Here's the second bedroom. Everything's looking really good. Okay, of course. So this will be definitely checked out. We'll let you know the age on this. Looks kind of on the line of 10 years or so, so we'll let you know. But as you can see, it's rolling along pretty fine. Okay, so the bathroom, as you can see, it's pretty good shape actually already as is. Just kind of rolling along from there. So yeah, I like that one a lot. And here's the final bathroom. This is the master. So this is really nice for a rental. In terms of this, yet again, have a master bath. And this one's really nice. Walk-in, bathtub and everything. You got a walk-in closet. This is really gonna help the rentability on this property. I mean, this is what everyone's kind of looking for in their bathroom. Yeah, you can pan around there. But yeah, it's looking really good. And yeah, that's a really nice walk-in closet. I like that a lot. Okay. Coming around here, let's check out the backyard. We just put in this security door. So, you know, a little bit tighter for, you know, most of our rentals, but it's got a great covered patio, nice little hangout, little zen, feeling a little zen area back here. I believe we're going to change out this AC over here, definitely rusted up, definitely over 10 years old. That'll probably be changed out. So yeah, that pretty much sums up this property. I really like the South Haven neighborhood, and we'll show you a macro view on this property as well later on. Thank you so much, guys. Until next time. Hey everyone, Sean Taggy here, Chief Operating Officer and partner of Memphis Investment Properties. It is a beautiful morning, the birds are chirping, spring is coming upon us. March 22nd, crisp 60 degrees, getting in the 70s every day now. So the flowers are starting to blossom and everything like that. We're real excited about this house, 317 Avery Jordan in South Haven, Mississippi. We are finished on our reno. It's been about 6 weeks since we've owned the property. Our turnkey buyer is ready to buy it. They're doing their home inspection and appraisal right now. The tenant is eagerly ready to move in once when all of that is complete. So let's go check out the property and check out our finished product. So we got nice security doors on every house, of course, is pretty standard. So just a full cosmetic renovation on this property. It was already in pretty good shape when we bought it, so we just kind of worked around with already the nice features on it, everything like that. But just a nice, crisp, smelling fresh property. Kitchen is a big, nice feature of it as always. We kind of paint our cabinets a little bit darker just so, fingerprints and other stains don't show up quite as much on them. So yeah, let's go around in here. So it's kind of new light fixtures, nice cosmetic paint. It's kind of a nice big bedroom / sitting room, whatever someone wanted to make that. Pan around there. All right, got a new thermostat in there and AC. Then here is just one of the bedrooms. Nice closet. There was carpet in here. We put in nice luxury vinyl plank flooring. This stuff is very scratch proof, indestructible, waterproof, tenant proof. Okay, straight across, another similar bedroom. Normal closet, pretty nice. Let's see, we're going over here. New HVAC system. We always check the HVAC systems. If they're newer, we keep them in. If they're older, we replace them, so that's really nice. You can kind of pan around that bathroom there, looking really nice. Nice, clean, safe, functional. It's not the Taj Mahal, but it gets the job done. Here's the master bedroom. Pretty nice space. And then this is a real big selling feature here, renting feature. You got a nice kitchen, second master bathroom, nice vanity, and walk-in closet, which is really awesome, and just a little bit more space in here. Let's go check out the backyard. A little tight area, but nice area, really close to downtown Memphis. So here's just our nice little cozy backyard. This covered patio area is really nice for the nice hot Memphis sun. Brand new AC with an AC cage on there. So yeah, I really like this area. South Haven, Mississippi. You're close to the Tanger outlets, which is really fun. I pop on down there a couple times a year, go buy me some nice new clothes that my wife makes me buy every once in a while. Close to downtown. Also an event centers nearby, lots of concerts. Actually, a rodeo's coming to town. That's pretty nice with COVID getting over. Gonna have our rodeo. So real fun, nice area. Thanks everyone. And this is one of our finished products brought to you by Memphis Investment Properties. On to the next one. All right, guys. Wow.
Wrapping up another
up.
day.
Day 4 of the Sofa Summit. On the way, becoming a cash flow king. Guys, yeah, today's been amazing. I love hearing about tax. I'm just super nerdy. I like hearing those numbers. Like, there is a return on just from the tax benefits of real estate. On our pro formas, we're actually very conservative on those tax returns, assuming like medium case scenarios. They can be even a lot better because you can write off. Now you've become a business owner. You own a little business of a rental property that produces income. So you can write off so much more, not only with the property, the depreciation, all your management fees and everything like that, but you can also write off flights over here to Memphis, meals you have over here, hotels you have over here, time you spend analyzing and things like that. Of course, consult your accountant on all that, but I've used all that and it is amazing. So I love the tax advantages of real estate.
Definitely. And what I really was shocked about and loved is that Mississippi is a great place to invest. I actually had no idea. In my mind, Mississippi was a plane ride away, a couple hours away, in a completely different market. When in reality, it's just a suburb of Memphis, Tennessee. That's the fastest growing industrial market in the country, that has amazing public schools, and is one of the fastest growing counties, is the fastest growing county in Mississippi. So that's my takeaway. Hope you guys liked it for the day. Make sure to get some sleep because tomorrow is the last and final day of the 2021 Sofa Summit.
Thank you.
See you soon.